We got some news about a little bit more details on maybe what the Fed's going to be doing, buying corporate bond and high yield ETFs. This morning we got word they're going to begin buying in early May. Not exactly clear what that means, but they'll be buying $75 billion worth, but they'll be able to leverage that between 7 to 1 and 10 to 1. Not exactly clear how they're going to make that decision. So it's a very large amount of money they're going to be buying. And in a shot across the bow at everybody who was trying to front run the Fed, essentially, they said they would not buy ETFs that are trading at a premium of 1% to the net asset value or even one standard deviation above the net asset value premium over the prior 52 weeks. And boy, was that a mouthful to get through all at one time. Dave Nadig, what do we make of this? This isn't far off from what we already know. It's good to know they're actually going to start buying because we actually didn't know anything about when and if they were going to buy, and apparently they are.
For all we know, they could have already started buying, so we've gotten confirmation that they haven't. The real news here is this definition of what too big a premium is. And there was a lot of speculation around this because we really don't have an instance where a government entity has come in and said what fair value looks like. So I think, obviously this is important for this specific set of buying facilities. We now know what the playbook looks like. I think this is going to have longer term implications, though, because now it's pretty easy to say, hey, what's too much of a premium or perhaps discount? Well, according to the Fed, it's 1% or one standard deviation more than the last year. I think that's a very reasonable way of thinking about that. The bond market is not nearly as efficient as we see in equities. So a plus or minus 1% on what is being called the net asset value is actually a very reasonable number. I do think this might have the interesting consequence of everybody piling into these ETFs, trying to get in before the Fed, and then the Fed maybe not even showing up because the persistent premiums.
Yeah, well, the premiums have collapsed, though. Simeon, weigh in on this. We went way above the premium, a premium to net asset value a few weeks ago, but that premium has collapsed. I looked at it at the close on Friday for LQD. I didn't see much of a premium at all there, and I don't think I saw one for high yield as well. So 1%, I agree with Dave. It sounds reasonable to me. What's your read on this?
Look, it's a reasonable marker. I mean, the one thing that most agree on with regards to the pricing of fixed income ETFs is that a lot of times the ETFs are just marking things to market before the less liquid bonds do. So that's an important marker. But also with regards to specifically the Fed now entering the market, I would argue that a lot of this was already priced in because they said that they could do it. So we saw spreads come in dramatically both in investment grade and high yield already. And even the mortgage market, which sort of had a minor kind of technical hiccup when this stuff first started, has started to calm down as well. So I think the medicine is working. The medicine already started to work, but it was good that they came out and told us a little bit more precisely what they were doing.
And Chris, I just want you to pick up on Simeon's point there. I think he's right in this debate. Why did we get such a wide spread here, a premium? It's because the ETFs had it right, not that they had it wrong. It was the bond market that couldn't price these products. What do you see down the road that could prevent these kinds of premiums and discounts occurring? Is there a more efficient way to price bonds? Do we need to go to more electronic trading? What's the lessons we can learn out of this now that everybody's not pointing the finger at the ETF business? Is why that happened.
Sure.
We all agree it isn't.
Look, I think those of us that have spent the last 20 plus years pricing ETFs on underlying asset information that's tangible and within arm's reach would love to see a more reliable and real-time bond pricing mechanism. Absent that, I don't think there's much, that we can do about it right now other than trust that the true liquidity providers and those who are taking risk in fixed income, both on the bonds themselves or with the ETFs, are standing firm. And this is where they value funds. Now, I will tell you, with the spreads that we're monitoring on a day in, day out basis, they're still, in the ETFs, the spreads are still a bit wide. You're starting to see days where they'll be trading flat to NAV or 50 bips up or 50 bips down, but more often than not, you're seeing days where they're pushing 100 basis points over or 100 basis points under. So I have a feeling, that the bond market is not entirely, out of the woods yet in terms of spreads collapsing to the narrow levels that we had seen in the past. both in high yields and in investment grade. If the Fed comes in and starts buying these and, they push it up to a 1% premium, and the presumption is that they're going to be using the published INAV, of course, that may not be the case. Maybe BlackRock has their own view of what it's worth, and they'll only pay 1% above that, if that's indeed who the Fed is hiring to do the bond buying. But the market is very wide right now. When there are sellers, the ETFs trade at a discount, and when there are buyers, they trade at a premium. They're whipping around a little bit. It's definitely a wider market for taking liquidity. Not as wide as we saw in the height of March, but it's still wide.
Well, I bring this up every week in the hopes that there's a little more of a microscope focused on this, and hopefully, I think it's clear where I stand. A little less over-the-counter trading, maybe more electronic trading will make it more efficient. At least we'll move the argument forward, and ETFs are not getting the blame.